Surviving in 2025, risk management, the most important thing. Time in the market, extremely important. That's one of the biggest assets, with just giving yourself some time to survive. Look, if you're a new trader, nobody's going to figure this out in a matter of months. Look, you can follow Nick's trades, you can follow my trades. I know that if you have no idea like how to trade Forex, if you have no idea how to trade options, if you have no idea what you're doing, look, trade small, demo trade, get the process, get comfortable navigating a broker platform. Those are basic prerequisites, but just don't do anything silly. Don't do anything stupid. Right now, it's like we need instant gratification, instant profits. We need to make 10x returns. We need to celebrate it on Twitter. It's all for show. I've been doing this for a long, long time. This is now 25 years into the markets. Okay. My biggest gain for a year was like 150%. And that was about when I had like $20,000. I made a lot of money, and I had some money tied to it in a copier service, and I turned like 20 grand to like 150K over like a 2-year window. That was like one of my biggest runs. From that point, it's been preservation capital. I just heard this last night on a podcast. It was some paraphrase quote from Charlie Munger, where the first 100K is very difficult to get to, but once you're there, it opens up a lot of doors. Because at compounding rate of 100K making 10% a year, you do the math on that, you see that it grows a lot faster, right? Like if you've got $1,000 to invest, okay, fine. But look how long that takes. Here's a fun story. This Invest America plan that they're going to give every newborn $1,000. Okay. If that's all you did was your kid, let's say I have a baby this year and I get $1,000. This isn't done yet. This is still in the works. This has to be part of this probably tax bill that might pass, probably will pass. But let's say every newborn kid in 2025 gets $1,000. How many parents, and I hope that everybody does it for the sake of your kids, but for every parent that gets $1,000, if you do invest $1,000 in the market and it annualizes about 8% a year, which is the historical norm of the S&P, your kid goes from born to 18 years old, and you're sitting on about $10,000 by the time they're 18. I'm sorry, but $1,000 one time is not going to change anybody's life. So the plan is Invest America, start the trading account. If at the very least the parent could do $1,000 a year for their kid, that doesn't take a lot of money, but you'll see like exponential growth. But it's time in the market, and it's consistency through the ebbs and flows, as opposed to we've got to trade every bull market, every bear market. We got to get every top and bottom. No, you don't. Right? If the market's pulling back, be prepared to buy more. If the market's going up, ride it. It's that easy, and it's not like the market's going to go up every single year forever. We're going to have pullbacks. We might have a pullback this year. We might pull back even further. I have no idea. But if we melt up to 6,500, if we melt up to 7,000, if you look out 10 years, we're probably going to be at 10,000 on the S&P, right? So if we go from 6,000 down to 5,000 again, the question is, in 10 years, are we still going to get to 10,000? Because I would imagine we could. It's just don't lose everything when we have a 20, 30% correction. Don't lose everything when we have a 20, 30, 40%. It's not easy to survive. But the point is, man, risk management is the most important thing. And time to stay in these markets will keep you from, blowing everything up. So I just think it's a funny initiative to see like $1,000, like it's this big deal. How's it not inflationary, right? We gave everyone checks in 2020 for like $500 and the whole world lost their mind on inflation. So how's $1,000 for every newborn, every family going to be non-inflationary? I have no idea. But when you look at the compounding numbers, if it's just a one-time thing and the parents don't invest in those kids, your kid has nothing to show for it. It's $250,000 to raise a child, roughly. It's probably going to get more expensive. You want to send a kid to college, it's double. So anyway, diversification, spread across sectors, asset classes, geographies, meaning it's not just a U.S. trade. Like, I like the U.S. markets because they're super liquid and we have some of the best performing stocks in the world. We have some of the best markets in the world. Believe me, the U.S. markets are far more liquid than everything else out there. Okay. I am mostly U.S. based, but my diversification this year is I have ETFs that are non-U.S. based entirely. So it's Europe and it's Asia. I trade in the Japanese yen. I'm trading oil. I'm trading uranium. I'm trading gold and silver and Bitcoin, which are just general assets. Okay. And on top of that, between sectors, U.S., non-U.S., between the trade sizes, it's tiny exposure. I mean, basically, I could summarize my pie chart as I have equities, I have gold, silver, I have Bitcoin, and I have other. The other would be Japanese yen, the other would be uranium, the other would be energy, the other would be like hedges and diversified assets. But a lot of these trades are very small that if I lost on one portion, if like one part of my pie failed, I'd have it hopefully picked up by the others to at least weather the storm, eliminate a lot of volatility, and not lose a ton of money. Does that make sense? Okay. Core income strategies. There's a lot of ways to do this. I mean, the boring stuff that I've been doing the last probably month has been, I have shares in the SPY, I have shares in the IWM, I have shares in the Qs, I have shares in Tesla, I have shares in MicroStrategy. That's 5 core positions. Okay. I trade a lot of options around them, and all that is I'll have some downside protection and I'll sell calls. And I do it every typically 1 to 2 weeks. If I can get enough money to roll it, I will roll it. It's anywhere between like 2 to 4 weeks. So every 2 weeks to 4 weeks, I'm generating for my portfolio, which is around $3.5 million right now. Probably helps me generate, let's just say 2 weeks out, probably close to like 10 grand every couple of weeks. And the markets don't have to go anywhere. If they go sideways, I can still generate that return. If they go up, I can still generate that return. I'm just losing a little bit of the price appreciation. But if I just keep selling, and things go sideways, like that's fine. If things go down, I'm fine. I've turned it into like a very boring income strategy because I'm not chasing this market to these all-time highs. I think that we can get there, but the courage to buy and participate through March and April was how I made a lot of money this year. Okay. It was having dry powder. It was being cautiously bullish going into this year and be prepared for the downside. And I didn't love it. I mean, I don't think anybody loved it. Watching Liberation Day on April 2nd to April 7th bottom, nobody loved the fact that the market dropped about 8 to 10% in 3 trading days. Nobody loved that. That's not easy for anybody because that rate of change is so severe that it just leaves people panicking. And we had that negative sentiment hurt so bad that 11 straight weeks. And the AAII sentiment survey reflected that people are scared and there's so much uncertainty that the bears are, 50+% of the AAII sentiment was bearish. And they're dead wrong, and they're clearly on the wrong side of the trade, because once we pivoted April 9th, it was a melt up for the last, almost 2 months. But the courage to buy during that downturn paid out very well. But here we are after a big melt up, running through a lot of resistance levels, getting overbought, seeing some rising wedges, just getting back to the all-time highs. I mean, the pain trade is more upside because everyone is still like, is it going to pull back? Should it pull back? Yeah, it should, but it might not. So I think a pullback to like 5,900, 5,800, 5,700 might be all we get. And this market goes into like global melt-up mode because the U.S. wants to stay stable and the world is going to benefit from a stable U.S. And possibly if the U.S. can grow through this, then yes, U.S. grows, world grows, right? But what's interesting this year is a lot of money is non-U.S. A lot of money has been migrated into non-U.S. because the U.S. is expensive. We do have the most liquid and best markets in the world, but it is expensive, okay? So, there's all sorts. I mean, if you've looked at the ETF space lately, there are so many tools to use. It's staggering how many ETFs are created that you can just say, look, I can buy the SPY that just sells covered calls. That's an ETF. And it performs like absolute trash in a bull market, but it does great in a bear market. Granted, the price is down, but you can generate, 8 to 10% a year on just selling covered calls. But there's ETFs that do that for you now. There's funds that manage that for you now. So even if you're a basic novice trader, there are tools out there that can allow you to, kind of dial up or dial down your risk profile. I just keep going back to, don't take too big a risk. Don't put everything in one trade, and just trade small. I mean, survive long enough. And like, this market gives so many opportunities to be profitable, but you got to be around to get it. You got to be around to take advantage of it, because too many traders are just going for instant gratification and going for, the fast money. And as enticing as it is, I mean, look, I would love to make hundreds of thousands of dollars a day, but I know that to make that, that's that much more risk. And if I'm wrong, I don't want to have that type of risk. So my job, as somebody that manages accounts, is I'm looking at the highest risk adjusted returns that I can make. So on average, my goal is to try to keep my drawdowns under 10% and my gains hopefully double or triple. And fortunately, the last 5, 6, 7 years, especially with incorporating a lot more heavy options trading, I've been able to do that. Index by the dip. So I think we're going to get a dip. I really do. I think that pullback to like 59, 58, 57, that would be areas where I'm looking to scale back in. I think we position for all-time highs again. I still want to have the asymmetry downside. I still want to have insurance out to the end of the year. If we roll into 2020, let's just say we're at all-time highs by the end of the year. I'm still going to roll into 2026 with very cheap hedges that could pay me 20 to 1, 30 to 1, 40 to 1 just in case I need it, right? I don't trust the sustainability of a 22 times earnings. I've got a slide that'll explain this, and I'll go into that in a little bit. But right now it's like buy the dip has been rewarding the retail crowd very, very well. The one thing I think is shockingly obvious in 2025 is the retail crowd was rewarded very well in 2025 thus far. Because what did the retail crowd do? Apparently, the retail crowd is the only group that's buying. And institutions sat on the sidelines, potentially positioned bearish. But just last month, like we had some major inflows in hedge funds. Okay, well they're playing catch up because hedge funds aren't mandated to do anything. They can basically have blackout periods and not tell anybody anything, and just they'll send you your statement every quarter. But if you have a mutual fund, I mean, you have to have like a mandate allocation. You've got to give back as much of the gains to the investors, but a lot of it's so passive. And a lot of it is so like basic stuff that you don't realize how it looks sophisticated on paper, but it's actually very simple stuff. Like an entire fund exists to just be 60-40, which means I own 60% of the SPY and 40% TLT, and that's my investment. And people pay for that, But buy the dip, it's like, look, the retail crowd's been rewarded for buying the dip. And if you look back 10, 15, 20 years, yes, we've had some windows where buying the dip could be painful, like 2022 when the market was down 35% from peak to trough. Buying the dip was painful. But we also had 10+% down, up, 10+% down, up, 15% down, up. Okay, so you dollar cost average, dollar cost average, dollar cost average. And guess what? Once we got through the rally, the end of 2022 was a Q4 rally. 2023 was all bull market. And we finally eclipsed that 2-year drawdown after the early part of 2024. So you did have a 2-year drawdown. But if you dollar cost average, dollar cost average, dollar cost average, what happens? You made money, you made money, you made money as we got to all-time highs, and now we are 20+% higher. You're making more money. You got to survive. You got to have some dry powder to buy those dips. Okay? All right. The way I plan on buying the dip for 2025 is I'm going to leave a massive wide margin for error. So if we get a pullback to, let's say, 5,900, 5,800, I'm going to position option trades where I want my bottom to be S&P 4,800. I'm going to be bottom on Qs, or bottom on NASDAQ is going to be my Qs at 400. Okay. I'm looking back at like April lows, and like I'm willing to own shares of SPY, Qs, Russell, Dow at April lows, but I'm going to position for them because I'm going to give myself like it's income. I'll do it on all my accounts, and maybe the dip from 50 goes to 62, 63, 6,400, and I'll participate in that a little bit. But for me, it's the income of taking, let's say 30 or 40 trades at bottoms with having a wide margin for error, So, I mean, to me, it's like that's safer money, give myself a lot of room for error, and still make the income in addition to participating in the upside. Okay. Favorite assets in 2025. I think if you're doing a scan nowadays, I use a pretty simple thing. I mean, when I scan for the markets fundamentally, I'm looking for companies that have cash, don't have high debt, and what's their forward guidance and earnings per share. If it's positive, profitable, without a lot of debt, that to me tells me that the company has runway to be profitable and successful. If obviously we're not overpriced and overvalued, if we don't have crazy high price to earnings, then it makes it a little bit better. I think value investors have been performing like garbage for the last 10 years because they're waiting for, oil to finally step up and non-tech assets to step up. It's just, look, you got to acknowledge, like, we are a tech-based economy and a service-based economy. If people are willing to spend money on services, great. If people are willing to invest, which mega is investing in tech, because that's the fastest growing and the fastest ripping and the highest profit margin sector that the world has ever known, is just high value tech, right? Man, I think there's a lot of ways to get the job done, but I want to see on paper I don't want a stock that can't make money. This is what happened in 2000. You had hundreds and hundreds and hundreds of companies that literally couldn't make money. They didn't make money, but their valuations were sky high because it was just pure tech euphoria. Okay. Are we there in 2025? No, not really. But there's a big difference between companies that, I mean, when when Nvidia can make what, $40 billion a quarter, and a company that is negative. There's a big difference. And I don't care that Nvidia is, it's priced out, it's expensive, and high. I get it. But if at least on paper it's making money every quarter, on the next like 6 to 12 projections is expected to make more money and maintain profit margins, that to me is something worth investing in, as opposed to, well, this stock is garbage right now on paper, but I think it could be. It's like, I'm not invested in what could be, you know. I'm really comfortable trading like what is. If we go in, like, especially if we go into, a downturn, or we go into like, look, is anybody going to invest in non-performing companies? If a company doesn't have the runway or cash to survive, I don't want to be in that stock, right? So this is why I trade the indexes a lot. I trade boring old ETFs like the SPY, the Qs. I trade SPX, NDX. I trade futures. I mean, stick the indexes. I don't have to be a stock picker. I can reduce volatility probably by 50+%, if not more, by avoiding a single stock play that blows up, right? Here's an example. I've got a buddy of mine that has traded for probably close to 8 years now, probably 8 years. He dabbled in penny stocks. He turns about $100,000 into like $4 million over that, like, I'll say 5 or 6 year window. Things were great. Talking probably, let's say, 2017, 18, 19, a lot of money, survived in 2020, melt up in 2020, 2021. So we had about a 5 or 6 year window where like he almost did nothing wrong. 2022, he started losing money. 2023, it's not been any better. 2024 hasn't been any better. 2025 hasn't been any better. Like, so long story short, $100,000 turns into $4 million. $4 million is now less than $500,000. That's 6 or 7 years of a career in trading that's now showing basically nothing for it. That's not fun. Unfortunately, I mean, it's a one-trick pony system. It's like, I still trade penny stocks. Why? When a stock goes to zero, or a stock you have to put 1,000 little bets on and hope that one pays out, and those stocks just magically get delisted, you're just losing across the board, and you have no control over how those things move. So I'm going to trade something that's big and liquid and is likely designed to go up. The S&P 54, 55, 56% of the time is designed to intrinsically go higher. And it can benefit from the broader market. It can benefit from this tiny little top 10 market. We have companies that are so big now at $1 trillion+ market cap, they alone can get the market higher. It's not great to have a narrow market like that, but if you trade the top 10% of the S&P, you trade the top 20% of the S&P, it performs a lot better than the bottom 90%, and has been for a while now. So anyway, I want to have quality companies. It's that simple. If I'm doing individual stocks, I want quality companies, or I want crazy high premiums if I'm going to take on the risk of those trades. Indexes. I trade a lot of indexes. S&P is my favorite. Dow is low volatility. Russell's a bit more speculative. NASDAQ is high flying, but man, NASDAQ is the best performing asset the last 30+ years. As far as indexes go, there's no comparison between S&P the last 30+ years to the NASDAQ. So, love or hate Bernie Madoff, the guy did create the NASDAQ in electric trading, and electronic trading has been a game changer. And tech, the top 100 tech companies, we are a tech-based industry. It is never more apparent than looking at the Qs and how they perform. Yes, they're more volatile, right? All right. Hedging is short-term plays. Now 0DTE, you can hedge every day if you want to. You can hold a portfolio long bias and you can hedge every single day to protect your downside. That's okay, but you'll just have a bunch of paper cuts that don't make money, right? So hedging to me is, I like to hedge out typically 90 days, if not more. So I'll do like a quarterly hedge, a half a year hedge, or a year hedge. And they're cheap. I don't like to spend more than 0.5%. But the asymmetry is they offer me, sometimes 10 to 1, 20 to 1 or better. But I trade index futures for a lot of hedging. Gold and silver. Silver's poor man's gold, but silver's, to me, like, I've been talking about this since 2024. I mean, I like silver because it's something I can see on the chart. having 35 to 40+% more upside to measure the all-time highs, to me, I'm excited about silver maybe getting to all-time highs again. You look at a silver chart in 2011, you look at a silver chart in 1980, the highs are up towards $50. Okay. So this recent break at 35, going from 35 to 40, or I'm sorry, 35 to $50, I like that I can measure that. I like that I can see that on a chart. You go to gold, gold's had a great bull the last couple of years, right? I think gold is clearly seen as like a bit non-dollar play. Bitcoin is wedging its way in there as well, but gold it's a great asset. It's always been a great asset. The 60-40 portfolio having equities and bonds, if you replace your 40% allocation of bonds with gold, it performs better over the last 40, 50 years. And right now, I think gold is really being taken in as a better asset store value than the U.S. bond market. And gold's been in a great bull market the last couple of years, and likely, geopolitical risks and escalating tensions, like gold can still maintain bid. Okay, Bitcoin. I mean, I've been dabbling in Bitcoin since 2016. I've been happy to see that like my little tiny bets with like asymmetry and upside, and like, look, I'll put 1% of my account into Bitcoin. Now it's more like, I mean, personally, I have about a 15% allocation to Bitcoin. Personally, clients, I have about 3 to 5%. Look, I can make 3 to 5%. If I'm dead wrong and Bitcoin goes to zero, I can make 3 to 5% back in my account. Okay, but that 3 to 5% that could potentially be 10x to 20x returns. Why would I not take that trade? And on top of that, like what is gaining more mainstream attention is that Bitcoin is serving as some type of alternative to this fiat system. So if we are going to continue to print our way to oblivion and devalue and debase our currencies across the globe at 120+% GDP that continues to rise and opposite of the 6 to 8% deficit every single year, Bitcoin is that potential hedge. And I know that's very extreme, but that's where the bigger adoption is coming. It's like, even if we ran a parallel system of, you can have paper money that runs like a checking account, but you can have something that actually appreciates on an annual basis 20, 30, 40%. And that can run in a savings account. That's what I look at Bitcoin as. That's what I look at gold and silver as. Like they're non-related, right? Like if the dollar gets weaker, they should go up. That's a good thing. If we print money into oblivion and debase, but they go up, things in terms of gold, things in terms of silver, things in terms of Bitcoin are cheaper. Okay, the house that I just bought 2 weeks ago, that I closed in this house. Okay, if I bought this house, 10 years ago with Bitcoin, it would have been however many Bitcoin. If I bought it today in Bitcoin, it would be like, I don't know, 5, 6 Bitcoin or 5 Bitcoin versus 20, 30, 40, 50 Bitcoin, 10 years ago. So the price of Bitcoin has gone up. The price of gold has gone up. Things have gotten cheaper in those terms. But in dollar terms, this house is going to go up $100,000 in the next 5 or 10 years. How? It's not worth anymore. Like square footage wise, it shouldn't be worth more. And that's where this funny money market is right now. It's like people bought houses during COVID at sub 3% interest rates, and those houses are now 2 to 3 times the price on paper. They're not worth that much. And in dollar terms, it's like everything's more expensive, but your dollar goes less far than it did, right? So anyway, I like things like they're appreciating. Bitcoin's gone up in value, gold and silver's gone up in value, and things get cheaper in those assets.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.